Dreaming about owning a home, but you have no idea how much it's going to cost? Don't worry. From everything to down payments to closing costs, we're going to cover it in this video. And it's really probably not as much as you might expect. In today's video, we're going to break down all the financial responsibility that you'll have in order to properly plan for this big move. And trust me, if you're sitting there thinking, Hunter, I'm never going to save 20% down, it doesn't matter, this is a pipe dream. You don't have to save 20% down. Almost no one does that anymore. Welcome back to Living in Spokane, Washington. If you're new here, I'm your local real estate broker. My name is Hunter McKay. If you're looking to prepare for home ownership or just have questions about the Spokane market, don't hesitate to reach out. Please hit any of the links below to get in touch with me or give me a call on my cell phone. I'd love to chat with you guys about everything that you need. Let's talk about down payment first. Obviously, if you have 20% down, that's fantastic. No one is going to tell you that's not a fantastic time to buy a home. Unfortunately, a lot of people think you have to save towards 20%, and you don't. The big difference that saving towards 20% will get you is you don't have private mortgage insurance, and you've reduced the principal balance of your loan quite significantly. So overall, between both of those things, you will have a lower payment. But a lot of you are probably thinking, I'm never going to be able to save 20% down. I live in a tier 1 megaplex city like San Francisco or New York. I might as well just move to Spokane, but even Spokane, the houses are expensive. Hunter, how will I save 20%? Don't save 20%. Just save towards 3% or 5%. And if you have good credit, you'll be amazed how that's totally workable. And I'll explain more how in this video. Let's talk about VA loans first. They're the odd duck out because they follow their own set of rules. They're also only available for people who have served in the United States Armed Forces, any of the military branches. If you have what's called your DD-214, your verification that you were part of the military in some way, then you can have your VA benefit. The VA benefit allows you to get an improved interest rate, usually better than the conventional or FHA rates, and you usually can go with 0% down and avoid mortgage insurance. Everyone who's not serving, you might be thinking, wow, those are a lot of benefits. Yeah, they got shot at for them, so we should say thank you. Thank you, service members, for everything that you do. Now go buy a house because you really do have this benefit, and it's one of the biggest things the United States government has given you. Take advantage of it. For everyone else, though, we're stuck with FHA, conventional, or USDA mortgages. USDA mortgages are only usable in rural areas, and they have to be in a declared USDA zone. So if you're interested in this, you just reach out to me and you ask, where are the residential USDA zones that I can look at? You'll be surprised. I once helped a client of mine get a 0 down on a USDA on something that felt very neighborhoody. I remember him asking me, I'm going to buy a house with $0. You're going to get the seller to pay the closing costs. I'm going to get a 0 down USDA loan, and I'm going to live in a neighborhood. And I said, sure, of course we are, George. And then we're going to fly off into the sunset together on our winged unicorns. Unfortunately, the client was right. We found the one property inside a USDA zone that still looked neighborhoody, and he did get the seller to pay closing costs, and he did buy this house with $1. It was pretty incredible. Not everything goes that way. It had to be a very specific set of circumstances, but he was very committed to his goal, and we were able to work together towards finding it. Brilliant day. The last two loan types that I want to discuss are FHA and conventional. FHA is usually used for people who have poorer credit. It doesn't mean you have terrible credit. It just means you have circumstances that are maybe not the best. You're putting less money down. You generally have credit scores between 620 and 680, and you might have negative marks on your credit, either a late payment or a default in some way, shape, and form. FHA is designed to still allow for those kinds of things to happen. Additionally, there is a down payment assistance program for both FHA and conventional. In both circumstances, when you use the down payment assistance program, the program will give you your down payment, but you carry an extra high interest rate compared to what the standard rate would be if you brought your own money. So realistically, if you can afford the monthly payment, you can get into an FHA or a conventional loan with 0 of your own dollars, You just have to be agreeing to paying a higher interest rate on that additional money that was lended to you, or an overall higher interest rate because of the risk of the loan. You're no longer putting money down, so your risk category goes up because the bank has to provide even more funds for you to achieve this outcome. The beautiful thing is that if you can afford to bring your down payment, just saving towards 3 or 5% will bring your interest rate down tremendously and impact your monthly payment in quite a big way. So to quickly wrap up, the minimum down payment for VA is 0%. The minimum down payment for USDA is 0%. The minimum down payment for FHA is 3.5%. The minimum down payment for conventional is 5%. Unless you're a first-time home buyer with good credit, then it's 3%. And so please, the next time grandma tells you at Thanksgiving that you're never going to buy a home because you can't save 20% down, just show her this video. Besides down payment, the other thing that you really want to consider are what are your closing costs and how much are they going to be, and frankly, who is going to pay for them, you or the seller? Because sometimes we can convince the seller to pay for them. Closing costs on most loans range between 2 and 5%. A lot of the time, if you're not doing a strange loan, anything with weird additives or any quirks happening to it, you're going to plan for just 3%. That's FHA and conventional. If you have a really good lender who can shave some of it off on his back end, then sometimes you can make it happen with 2. But I like to let everyone know, if you want to know how much you're going to spend, add an additional 3% for all of the closing costs. And in order to break down, well, what are closing costs? It's things like the loan origination fee, the title, the appraisal report, the inspection fee is actually paid separately, but is still maybe considered a fee here. You would also have a recording fee, doc prep fee. Any of the additional points that might be paid to buy down the rate could be considered a closing cost. And so you really want to make sure that all of these things are being listed, because to the closing company, the closing costs are just their fee. To the lending company, the closing costs are probably just their origination fee. But to you, the buyer, the closing costs are also your prepaids and your taxes and your pre-escrows that are collected at the time of closing. You want to know how many dollars are going to come out of my pocket, not how many dollars come out of my pocket to you, the individual company. I want to know how many are coming out, period, in total. The best way to get a full understanding of all of your closing costs, have your lender provide what's called a loan estimate, and then give that loan estimate over to your real estate broker and ask them to call their closing company and put that together and compare the fees to make sure that they're correct, compare to make sure that all of the lenders have put together the right list of insurance, that the insurance is listed correctly, double check with your insurance vendor, double check to make sure that the title and escrow are actually correct and not just estimated. And once you've confirmed all of the estimated details, go back to the lender and double check to make sure that they're not missing anything on their end. Once you have all of those pieces, you should have a clear understanding. And throughout the loan term, if anything changes during escrow, you can know exactly what shifted. Because sometimes it's true, you'll get an estimate in the beginning with the loan estimate, and the final closing paperwork will be slightly different. Usually just a couple $100, but you still want to know exactly what changed. What were they making the estimations on? And was it that things changed because the deal changed? Or was it that they made a mistake and they didn't inform you about it properly? Because both can happen. One of the easiest ways to reduce your personal closing costs is to ask the seller to pay for them. In a market like we have right now, it's become common for the seller to contribute some money towards the buyer's closing costs. Maybe they're not willing to pay for all of it, but if the closing costs on a home are going to be $15,000, maybe you offer list price to the seller, but ask them to contribute a $10,000 credit towards those closing costs. Or maybe you pay all of your own closing costs, but you ask the lender how much it would cost to buy down the rate in order to reduce the monthly payment. Then you go back to the seller and say, hey seller, would you be willing to cover that closing cost credit? I can cover everything else. I just need you to cover the buy down. Then your monthly payment is low enough that you might be happy with the outcome anyway. There are additional expenses when it comes to buying a home though, right? Everyone pretends it's just the down payment and the closing costs, but what about the new couch for the living room, the new linens that you just have to have from Bed Bath & Beyond, that new Lululemon, pantsuit that's going to look great in your brand new closet now that you have final space for it? All of these things are additional expenses. And you might be thinking, well, Hunter, I'll just put it on a credit card. It's fine. How much can moving really cost? It can be expensive. And if you put it on a brand new credit card, I'm going to find it before closing and it's going to fuck up your loan. Don't do that. Please be aware of what you want to spend on besides just acquiring the home, and make sure that you have all of those additional expenses worked out. The big ones that I see people ignore: the furniture and the stuff that they want for the house, and the moving costs that they need in order to get there. So just plan for everything. All right, so how do we really get financially prepared to buy a house? What do we need to know and what do we need to do? Let's go over it in this section. Two of the biggest things that can impact your ability to qualify is your credit score and your debt-to-income ratio. Your credit score is really scored by the three major credit bureaus, and they take your middle score. So let's say that your top score is 700, your bottom score is 670, but your middle score is 680. Your credit score for the purposes of the loan are 680. And good credit is anything above 740. Okay credit is anything between 680 and 720. And bad but acceptable credit is anything above 600. There are certain lenders that can go all the way down to a 580, and there are even certain vendors that can go all the way down to 500. But I really want to be clear about something. If you have a 500 credit score, there are probably other issues going on in your life that we should tackle first before we try affording a house. It's not that we can't, it's just that I think that there are probably other ways that I can be helpful than just saying, yeah, let's yeet you into a home without issue or worry about how expensive that payment is going to be. Besides credit score, they also look at your debt-to-income ratio. That means if you make $4,000 a month and you have $2,000 in debt going out every month, you're at a 50% DTI. They're probably not going to approve more debt at that point because they don't want to approve anything above 50% usually. There are certain examples where this is not true. VA and USDA loans can have increased DTI for certain circumstances, but depending on your credit, they may also have lowered DTI. FHA and conventional usually stay pretty standard depending on the lender you're working with. You're going to be anywhere from 40 to 48% DTI, and you just got to chat with your lender and say, what is your debt to income ratio maximum on the front end and on the back end? What is allowable? And then ask them what actually goes towards that debt to income. Debt load that will count is things like your car, your credit cards, your health, medical bills that have been put on a long-term payment plan. Any debt that is structured on a payment plan is going to get covered. But your utilities don't count. You know, the money that you spend on your nails and your hair, those don't count. Money spent on clothing doesn't count. But if it's on a credit card, that credit card payment can count. If it's on a car, that car loan is going to count. Student loans, medical loans, anything that is attached to a loan, they're going to consider it part of your debt to income ratio. And a lender may ask you to pay those things off before they'll approve new loan terms for you on your house. One of the first things that you should do is go chat with a lender. Even if you haven't saved the down payment yet, just talk to a lender. We all get so afraid reaching out to the lender because we get put in a system. They call us back to follow up. They ask us how we're doing every Tuesday. Terrifying, I know, right? People wanting to work with us. But at the end of the day, they're there to help you. They want to support you towards getting a home. And so go meet with them, talk about your income, talk about your debt, and have them help you by giving you a homework list. Save X amount of dollars towards your down payment. Save X amount of dollars towards your closing costs. Save and pay off these different debts because they're negatively impacting your DTI. And if you ignore all of those factors before and just say, well, it's fine, I'll figure it out when I found my dream home, you're not going to have enough time. Someone else is already going to have done this work ahead of time because their realtor and lender asked them. And so when both of you are competing for the same house, their homework's going to be done and they're going to go write a clean offer. You're going to want to write an offer, but I'm going to have 17 things for you to go work on in a 24-hour period. You're going to get stressed out and you're going to go home and put on pajamas and get a big carton of ice cream and you're going to cry. It's not going to be fun. Don't do that. It's really not hard saving to buy a home. I had a meeting just the other week with someone that was moving into a very expensive rental that I manage. And he said, man, I just hate that I'm never going to be able to buy a house. And I looked up at him and I said, sir, you have a 750 credit score and you have qualifying income allowing you to rent this very expensive apartment. If you can afford a $1,600 one-bedroom apartment in Spokane, Washington, you can afford to own a house. and he was dumbfounded. He had no idea. And this gentleman has good credit, a good job, no debt. And he just thought that he had to save towards 20% down. You don't. So take this as the sign from the universe to pick up your phone and call all of your friends and family that need housing and tell them to call me, because we can work through a very simple, short homework assignment that gets them prepared to take action on buying a house. If you have bad credit, you can fix it. If you have no money, you can save. If you have a bad budget, we can help you figure out what to cut from the budget. Everyone can afford to buy a house. Maybe not the home we dream of, maybe not our Macaulay Culkin's dream home where we get to live our Home Alone fantasies, but we can buy a house that's better than our shitty 1 or 2 bedroom apartment. If you found this video helpful, thank you so much for staying to the end. Give us a like and a thumbs up. Those are still the same things, but I keep saying both. So what I mean is subscribe and like. That way I can get the benefit of knowing that you are watching these videos. And if there's anything that you need that's not covered in these videos, just call and reach out. I'd love to help. If there's a video that you'd like to see in the future, leave us a comment and let us know how we can help with that too.